renovations, which typically happen in like a large apartment building. You might renovate over several phases. So you're getting all of that wealth creation, despite the fact that there's $0 left in that investment. And then you're free to take that bucket and buy the next thing and the next thing and the next thing. So it was always a very intuitive business model to us. And that's why we stuck with it.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying the show, leave us a rating and review. We want to hear what you love about the show, but also anything to make you work harder for your investing goals. And if you haven't done so already, make sure you hit that subscribe button so you don't miss an episode. Now, we've got a great show today. We're going to be talking to Elaine Stageberg. Elaine Stageberg is the MD, MHA, a psychiatrist, mother of four, and owner of Black Swan Real Estate. Now, she owns and manages a portfolio of over $330 million worth of assets under management. And through real estate investing, she has reached financial freedom in her 30s and now helps others to do the same. Let's welcome to the show, Elaine Stageberg.
Thank you for having me. Excited to be here today.
Absolutely. Listen, I went over your bio at a very, very high level, and I gave some acronyms with the MD and MHA and some of those things that some folks may not be familiar with. So why don't you take 2 minutes and give us a little bit more context on your background?
Yeah, happy to do so. So I'm Elaine Stageberg. I'm a physician. I'm a psychiatrist. That's the MD part. I also have a master's of health administration and policy. That's the MHA part. So that kind of gets you through my name there. I'm married to my husband, Nick. We've been married for 12 years. We run our company, Black Swan Real Estate, together. We have 4 amazing children. We joke that we like to do everything at scale, whether that's our real estate or our family. And then Black Swan Real Estate is a real estate investment firm in Rochester, Minnesota, which is where I'm physically located, and Tacoma, Washington. We have over 300 million in single family homes and apartment buildings, so all long-term residential real estate. We have a small amount of commercial if that's part of like one of our apartment buildings, but we tend to stick with long-term residential real estate. We're very vertically integrated. I'd love to, talk about that during our time today, because I think that's something that really can set someone apart in their investment journey if they're on the active side, really thinking about ways that they can add value to their investors. And if they're on the passive side, thinking about looking for a general partner that has vertical integration because all of the benefits that come from that. So we started investing just kind of your, typical mom and pop. We got married. We both owned our own homes. We decided to rent out the home that I lived in and moved into my husband's home. And we were accidental landlords. That was back in 2011. And got bit by the real estate bug as I was seeing some cash flow come from that property, seeing the mortgage get paid down, and then the value of that property improve. Because if you think about 2011, that was kind of after the bottom of the bottom, and seeing the values go up. We bought our first, what I call intentional real estate investment property a few years after that. It was a VA foreclosure. It had been vacant for 9 years. We paid $35,000 for it. Like, just all of the crazy things that might be running through your mind as you're hearing those things. That's how crazy it was. Like, I'm not exactly sure what exactly we were buying. I guess the land and the frame and the roof. Renovated that house, did most of those renovations ourselves. We hired professionals for things like the HVAC, the roof, the windows, the things, where we needed to have license and permits and stuff, but did as much as we could ourselves. And that's really when we got bit by the real estate bug, because we were able to have the first iteration of what is our business plan to this day, which is acquire distressed property, increase the value through either physical renovations or management improvements, almost always a combination of both. Do a cash out refi, get all of that money back, and then be able to take that bucket of money and invest in the next thing while the first property is still generating cash flow, debt pay down, appreciation, and tax advantages in that infinite rate of return model. And that's the model that we've had all the way through, all the way up to, a third of $1 billion in assets under management. It's all been that same BRRRR business model. We get to an infinite rate of return as quickly as we can. We've never sold a single asset. And so as we grew and we reached financial independence, with our own portfolio, people started coming to us, asking us to, invest alongside us. And that's how we created our joint ventures and then our private equity funds. We just closed Fund 2 at the end of last year. We'll open Fund 3 this year. And it just all goes back to that same business model all the way back at the beginning.
I love it. I love it. Lane, you gave a lot of great context and details on how you got started, right? You talked about being an accidental landlord. You
Mhm,
got married, rented out your home, and then became intentional landlords when you bought this 9-year vacant property that's off this VA foreclosure, renovated that, made money, and then the strategy that you employ is finding distressed assets, renovating them, increasing the operations or improving the operations, and then refinancing and creating this infinite return structure. So I think that's really unique and interesting because you talked about not selling these assets, keeping them,
mhm,
having this infinite return structure. And I know most groups like to find properties, do a lot of the things that you mentioned, but the goal at some point is to sell that asset or to exit. You like to hold on to them. Can you
mhm.
talk a little bit more about the infinite return structure or model that you like to use?
Yeah, so Warren Buffett says, "My favorite hold period is forever," and I concur with that hold period. We joke that the name of our company is Black Swan Real Estate, but we really should have named it like Golden Goose Real Estate. And so it was just always intuitive to us, very early on that all of the effort that it takes to find a property, decide that that's the property that we want, get through the negotiations, get our offer accepted, do the renovations and most importantly, do the renovations with an ownership mentality. So not just paint and carpet, but high quality paint, LVP flooring, putting in all new cabinets, countertops, doing, the heavy lifts if it's needed, like HVAC, plumbing, windows, roofs, really thinking, how do I want to renovate this property so that over the next 20 or 30 years, as I continue to own it, it's a good solid property that will hopefully have lower maintenance expenses, and then doing the cash out refi and doing all of the steps that it takes to get, good high quality debt in place on that property. It just is baffling to me. I concur with you that most groups at that point sell, but they don't do a refi, they do a sell as their exit. But it's just so baffling to me why someone would go through all of that effort and then end it. Kind of the thing I like to say is, in my mind, that would be akin to developing this great friendship with someone. You get to know them, you know what foods they like, what foods they don't like, what restaurants they want to go to, what things they want to do, what their favorite colors, all the things that it takes to develop a friendship with someone. And then at the end, you would just say, well, I'm going to go make a new friend. I can't be friends with you anymore. Well, you can just be friends with the old friends too, and the new friends through a cash out refi model. And then you're in that infinite rate of return period. So a huge part of our scale in our personal wealth and in the wealth that we're generating for our limited partners is there's a certain level of acceleration that comes from taking a single bucket of money, using that to acquire an asset, getting that bucket of money back via the cash out refi, but continuing to hold that asset so that you benefit from future cash flow, future debt pay down, future market appreciation, future forced appreciation if there are subsequent rounds of renovations, which typically happen in like a large apartment building. You might renovate over several phases. So you're getting all of that wealth creation, despite the fact that there's $0 left in that investment. And then you're free to take that bucket and buy the next thing and the next thing and the next thing. So it was always a very intuitive business model to us. And that's why we stuck with it. Um, things like IRR never made a ton of sense to us. It just that it's such an abstract sort of, quite frankly, kind of like made up concept that can be really manipulated based on time of sale and all of these things. But real wealth is, how much passive income do I have coming in every month? How much assets do I own? And how much is my net worth growing every year as the value of those assets go up? And the way to do that is to own a lot of assets, and the way to do that is to take one bucket of money and use it over and over and over again in an infinite rate of return model.
Elaine,
And
I love what
that
you
goes all the
said.
way for someone that's, investing with themselves or a spouse or a
Right.
family member, a very small portfolio, all the way to, large scale private equity. That lesson can apply regardless of where someone is in their investor
Yeah.
journey.
Elaine, I love what you said there and the way you break that down because I think it's really interesting and helpful for people to understand how that works, right? So one, what you're talking about is finding distressed assets, investing in them, fixing them up, getting the operation strong to the point where you can refinance and being able to pull out 100% of that invested capital. So if you can do that, now you got that initial capital back in hand that you
Mhm.
can go redeploy into another deal while still holding that first property and continue to get the cash flow benefits from owning that property. I know part of the reason more people don't do that, or that people look to sell that asset, is maybe they're not able to get all that equity out. Maybe they're creating some value with these deals with their business plan, but it's not necessarily enough to get 100% or maybe even 75% when they refinance. So that's one of the challenges. So with your model, I know you said the word distressed, and I know some people are distressed and maybe they have one picture of what that means, and maybe some
Mhm.
people are just looking for something that's stable, where it's just a little bit of a value add. Talk to us about the kind of properties you're actually looking to acquire. Like, what status are they in? Are they completely vacant? Or just give us a little bit more context on kind of where you're starting with these properties.
Yeah, so our buy box is actually quite large. It does take some creativity to think about, well, what will the value add plan be for this particular asset that can get to that infinite rate of return? So the thing that we look for is what's called payback period. So payback period is the amount of time in months or years that it takes to get all of the invested capital back. We plan for at most a 5-year time period on our payback period. Historically, it's taken more like 3 or 3.5 years. We don't have a single deal that has taken longer than 3.5 years, but we always want to be really conservative in our projections. And if we can find an opportunity that we have a strong reason to believe from all of our pro formas and our business plans that we can get all of the capital back in 5 years or less, then that's a win for us. That's something that we would consider writing an offer on and acquiring. That can look like a very distressed single family home that truly needs, a gut to the studs renovation. That can look like kind of a tired single family home that's in good shape in a good neighborhood, but maybe really hasn't had a lot of love since, the early 90s, mid 90s, those sorts of things. That can look like very distressed apartment buildings that need a lot of physical renovations, that need good, strong management, that need someone to really steward that community and manage it very well. It can also look like, what some people might consider to be Class A or Class A minus new construction. So an example is kind of great timing with our recording here. So tomorrow we are closing on what some people might consider to be a Class C minus or maybe even D plus, like probably one of our least nice apartment buildings. It's about 30 units. It's in a great location in Rochester, Minnesota. And essentially, we're acquiring the land. So we're getting an operating apartment building that we will do a small amount of renovation on, just to make sure that it has the quality that we want to put our name on it and to be excited about renting that to residents. But really, the plan is to demolish that building, to upzone the land, to increase the value that way, and then to ultimately build a very large apartment building on that. So we'll be able to get our cash out from that deal simply by increasing the value of the land through upzoning. So that's one example. A completely different example is we're closing on something in about a week that's a Class A minus new construction, built in 2019, 129 units, and the entire ground floor is vacant commercial space. So 2019, we all know, was a completely different universe. So when this building was built, there was an expectation that there might be a pizzeria and a coffee shop and maybe a small hair salon and maybe a small branch of a bank, those sorts of things for walkable commercial traffic. Well, COVID changed everything. So this space is still vacant 4 years later. So we are acquiring it and we are building 2-story urban townhome apartment units in that ground floor level. So when we're done with our final construction phase, the entire building will be long-term residential. There might be a small amount of space that we put maybe like a small coffee shop or something in, but you can kind of think of it as that all of that commercial space will be converted to residential space. And that is what allows us that margin to have the increase in value to be able to do a cash out refi in about 3 or 4 years. So all the way from something that's, a Class D to something that's a Class A, completely different business plans, completely different structure. Both of those kind of have a development component. So I'll share another example. In October, we acquired a 100-unit townhome community built in the early 2000s. So really didn't have a ton of physical distress. We did negotiate through the purchase agreement process that the seller would replace all of the roofs. And we're doing some mild renovations, putting in new flooring, new paint, but we're not like gutting kitchens, gutting bathrooms. 50% of that community was non-paying simply because of poor management. When we spoke to the manager, we really believe in coming at things from a place of curiosity. So what's going on here? What's happening here? And they said, well, our metric is physical occupancy. That was very confusing to me as a real estate investor and someone that owns a property management company, because physical occupancy is important. But
This is the owner or the property manager who said this to you?
the property manager said that at the guidance of the owner, they were to emphasize physical occupancy. The property manager and the owner all knew that the rent roll was 50% economically vacant, and they were okay with that for whatever reason that is very hard for me to understand. And I see the look on your face of like, that's a very confusing situation.
Wow.
We value, of course, physical occupancy, but ultimately we value economic occupancy,
Yeah.
right?
Yes.
So we acquired that asset. That took a lot of conversations with our bankers to help them understand why we wanted to acquire a 100-unit townhome community with 50 non-payers, why that was a good bet. We own our property management company. We talked about vertical integration right at the very beginning. So we're willing to take on that extreme lift that it takes to acquire something and then immediately have to reposition that entire community and do so in a graceful way that acknowledges that these are human beings and families that have been allowed to get into a bad situation by the previous management company, and work with some of them on debt amnesty, payment plans, helping them to vacate and just remove their debt if that's what made most sense for them, helping them to get rental assistance. But the big lift that it takes, so there was very little physical renovation happening at that one besides carpet and LVP. I'm sorry, taking out carpet, putting in LVP and paint, but no, major construction there. That one was all management improvements. So those are just a couple of deals that we've put together in the last 6 months that you can see how the number one criteria is payback period. There's wildly different ways to get there, and it can be done with physical renovations, management improvements, almost always a combination of both.
Elaine, I love those examples. You gave us three really different, really distinct examples of how you're creating value on these deals and taking kind of, underperforming or distressed assets and bringing them up to where they should be. That first example was really more of an upzoning play where you're going to buy an asset, eventually knock it down and actually build a larger apartment building there. The second play was buying that Class A 100+ unit community where it has that commercial on the bottom floor. Commercial is not being utilized. You're going to go ahead and create kind of these 2-level duplex units in that commercial space and get it all to be residential. And then this third one here, which I laughed at. Anybody watching this on video can see the reaction, but I think for newer investors, they may not understand the difference between physical vacancy and economic vacancy, right? So you just, you're starting out, you just see vacancy, right? It's like income or rent, vacancy, and then your expenses, right? And just to make sure we're catching everybody up here, just because someone lives at the property doesn't mean they pay rent, right? Doesn't mean they pay rent on time. And for business owners, that's a part of our cash flow. We have to make sure that one, this person's paying rent, but also even if they are paying, we don't want to get paid, 30 days late, 60 days late every single time. So we've got to factor that into our operating budget. And for whatever reason, the owner and property manager only cared about the physical vacancy, meaning there's a body in the building, versus making sure that body actually paid rent. So that was a challenge you had to overcome. And you talked about being able to do that gracefully, helping those residents. And because you have your own property management company, you were able to assume that risk because you knew what it took to get that property performing. Out of curiosity, how long was that process? You come in with the property, 50% economic vacancy, and it sounds like the physical vacancy was probably only like 10% or less. So you had a lot of people who were living there not paying rent. How long did it take you to correct that and get it stabilized?
I would say today, about 6 months later, I feel pretty stabilized. At this point, I believe we have
Okay.
2 non-paying residents that we're still working through the eviction process. So there's some broad generalizations here in the interest of time, but we acquired it in October. We immediately had messaging to all of the residents that ownership and management had changed. To the 50% that we're paying, we just sent out basic letters saying, here's how you pay, here's how you submit a maintenance ticket. These are the improvements that you'll see around the property. This is how you reach us. And then to the 50% that we're non-paying, we reached out and said, here are some options. You can get caught up. You can get caught up in a payment plan. You can leave and we will waive the debt, because it wasn't really debt that was owed to us, and we had it in our purchase agreement that we were not obligated to collect it. So we weren't really losing money that we ever really should have earned. So that was a win-win scenario. Here are some places that we can help you with rental assistance. And if none of those work and you continue to not pay, there will be legal consequences, including eviction. We were able to work with probably about half of those folks to get them caught up, to put them on a payment plan. People paid 5-6 months of rent in one day. Like, I kid you not, when humans know what the boundary is, when they know what the rules are, when they know that the lease agreement will be adhered to, people follow that. Like, the extreme majority of people are good people, and we're all humans and we're all testing the boundaries at all times. And when you find that there are no boundaries, you behave as though there are no boundaries. When the boundaries are put back in place, you behave as though there are boundaries. So many people caught up within a week or so. Many people did payment plans. A smaller number did rental assistance programs. A fair amount, I might estimate maybe 10 or 15% of the total. So like 15 of the 50
Right.
decided to leave and have that debt waived. And then a small number, probably only 4 or 5, did we have to go through a legal eviction process. All of that took about 6 months. We made the decision in mid-December to basically halt any type of debt collection, moving people out, evictions, and we halted that from mid-December through the first week of January, really just out of the goodness of our hearts. Like, we weren't going to substantially change the financial performance of the asset in those 3 weeks. And again, recognizing that these are humans and families and children involved. So that delayed us, let's say 3 to 4 weeks. But I would say the bulk of it was completed in 4.5 to 5.5 months.
Okay. I think it's very helpful too, even for those folks who are operators, to understand how to navigate that situation, because you may be in a situation where you acquire an asset, either you didn't know that these people weren't paying rent, or now that there's a new owner, they're going to test you. They're going to see how you
Exactly.
react, and they're not going to pay, and just, oh, I sent it to the last guy or whatever the case may be, and now you're sitting here stuck. So, what I'm taking away from what you said is you want to be firm, but you also want to be fair and give these people a chance to pay, to get caught up. You want to handle this with grace and give them some options so that they can actually, kind of choose the outcome that's best for them, and you moving forward. But also make sure that you set those boundaries, and that's going to be really, really clear. And this is something I think too, coming out of COVID in particular, but even now with the current lending environment, this is another way for you to create value. Look for these deals where maybe there's some operational inefficiencies, and see how you
Mhm,
can come in and manage this thing better. Now, we've talked
mhm,
about you being vertically integrated, right? You've got your own property management company. You invest in two markets that are nowhere near each other, right? So you're in Tacoma,
mhm.
Washington, and then you're in Rochester, Minnesota. How are you building your teams and kind of managing the scale in these two vastly different markets?
Mhm. So interestingly, Tacoma is not that far away from Rochester because we can zip right up to Minneapolis, get a nonstop flight. It's about 3 hours, 15 minutes. So we can be from our door at our office here in Rochester to the door of our office in Tacoma in about 6 hours. So that's certainly not a daily commute, but it's really not that bad because they both have really good airport access. That's a big part of why we're in Tacoma. So all the way back in the beginning, we self-managed our properties. At that point, it was out of interest and curiosity and wanting to steward our assets. It was also out of a financial necessity that, just the mortgage to the rent, we needed to collect every penny that we could. So that was a way for us to save costs. And then as we got to about 20 or 25 properties that we personally owned, so these were all single families, maybe a few duplexes, it became pretty challenging. So while this was happening, I was a physician. We were having these young children. My husband had a career in technology. So we were both working full time, me kind of full time plus, and then building our family and building this rental portfolio. And it got to where at about 20, 25 properties, there was always a maintenance ticket, always something that needed to be photographed for listing, always a turnover that needed to happen. So we had to make a really big decision at that point. Do we hire a third party manager, and kind of that would be our investment philosophy going forward, or do we create a property management company? And about a year before that, my husband had gotten his real estate license, mostly to represent us, mostly to allow us easier access to properties, that we could do first party negotiation, which means there's no agent negotiating because he is the agent. So it kind of cuts one person out of that communication chain. And that allowed us the opportunity to create a property management company. And so it wasn't something that we planned years in advance. It wasn't this, grand plan that over the next 10 years we'll develop a property management company. But when we saw how we wanted to steward our assets and how we were willing to acquire properties that had a lot of physical distress, management concerns, and do that heavy lift because we were owners, so we get equity, right? So in the situation with the townhome community, a property management company usually collects off of gross rents. So if 50% is economically vacant, they're probably not collecting a lot. And it's a big lift to do all of that communication, all of those notices, all of those really difficult conversations. But when you're the owner and you know that that's improving NOI and that there's a handsome multiple in real estate that's improving the asset value, all of a sudden that makes complete financial sense to be able to put forth that effort. So we created our property management company. For a while, we did do third-party management where we would help other investors acquire properties. We'd serve as their project manager, help them with renovations, and then manage. We no longer offer that service. We now only manage things that we own directly. And it allowed us to have a very wide buy box. It allowed us to take on really challenging projects. It allowed us to have the quality and the control and the consistency that we wanted. It allowed us to enter into projects like, say, in that townhome community, to say, here are all the things that we're going to do as the owner and the manager. We will adhere to our portion of the lease. We will make sure you have a superbly maintained unit that you're excited to live in. We will make sure that the common areas are in great condition, that we're adding amenities, that you're excited to live here, that you want to live here, you want to bring your friends. These are all of the things that we're doing as our part of the deal. And we know that because we're both the owner and the manager. And it evolved so naturally. And so today, what we're doing is going deeper and deeper into that vertical integration. So we have our own property management, we have our own construction, we have our own maintenance. Now we've added our own cleaning. We're adding lawn, snow. We joke that probably in a year or two, we will have our own trash truck that drives around and services all of our buildings and goes to the city dump. But I'll dive into cleaning as a teaching example for people both on the active side and the passive side. When you have a third-party vended service and you hire ABC Cleaning to go, maybe they're doing a turnover at Unit 101. They walk in, they go into Unit 101. They probably do a good job. If you have good vendors, they do high quality work, and then they walk out. And that's completely okay because that's the contractual relationship between you and the cleaner, that they go clean Unit 101. But when you have vertically integrated cleaners, they see that there's a couple pieces of trash on the ground. In Minnesota, there's a ton of snow. So as the snow melts, all this little litter and just sort of ugly stuff starts to emerge from the snow. They pick all that stuff up. They see that there's some tape on the window from, maybe we had a resident event and there was an announcement and that paper has come down, but that ugly tape is still there. They take that off. They see that there's some packages in the entryway. They stack them up, make them look nice. Maybe there's 6 of them and they're, this is a smaller building. I'll just run and drop them at the doors. Then they go into Unit 101. They do a superb job in there. Then they come out, maybe on their way out, they see that someone put something in the dumpster that doesn't belong, like a mattress or a couch or something like that. They immediately can call a maintenance person who is one of their colleagues. They're not calling a vendor. They're calling a colleague they're on the same team together and say, hey, there's something in the dumpster that shouldn't be here, or hey, I saw a piece of the siding kind of flapping in the wind, put a maintenance ticket in, let's get that fixed. And you only get that with vertical integration. You only get that with a staff that understands asset ownership, that understands where they fit into the model of asset management. So when you have a cleaner that is doing asset management alongside you, the outcomes that you can get are staggering. And so even though vertical integration is really challenging, it just has always made such intuitive sense to us that it would be the best way to steward our assets all the way back from the beginning.
And you obviously have a knack for putting in the systems and processes and maybe even finding great people to help run and drive these processes. Talk to us a little bit more about that, right? The infrastructure that you put in place and finding the right people and how you actually manage to keep kind of the wheels moving here.
So one of the pieces that's really important to understand in the story is that along the way, my husband left his career in tech. I left my career in medicine. So we're running our company full time together. We both take the excellence and the professionalism and the culture from those industries. My husband led a team of 13 software engineers at the Mayo Clinic. I led many teams in my role as physicians. So we have that leadership training, that leadership ethos that comes from our professions, and we're bringing it to our company. We really believe that the role of a leader is to cast the vision and to say, this is our culture, this is our shared language. How do we get there together? And then it's the role of the team to come up with the way that they get to the end outcome. We're big believers in continuing to surround ourselves with people who are further ahead than us. So we do lots of masterminds. I do strategic coach, which I highly recommend to any entrepreneur as a really concrete, detailed way. I joke that strategic coach is almost so simple. You kind of think to yourself, like, what am I paying for? But that's what you're paying for, is they take all this, as entrepreneurs, as investors, as people that are creating value, our brains are naturally wired of like, I could do this and that and this, and what about this thing? And strategic coach is like, put it on a worksheet. And that's how you translate it to, we have 32 team members here in Rochester. We have 27 in Tacoma. You translate that vision by getting really simple, really concrete. And my husband and I spend all of our time doing leadership. So we do very little actual operations. And in fact, when we find an operational concern, we go to our team and we say, here's this operational concern that we're seeing. I was meeting with our director of growth. So that's our leasing team earlier this morning, saying, here's some vacancies that I'm seeing. Here's some things that I might do if I was leading this team to cure these vacancies. Have you tried this? Have you tried that? And then letting that person grow and lead his team and develop those skills so that we can expand our reach more and more.
I love it. You just gave a master class really on how to scale any kind of business. And you talked about a couple things. So one is understanding your zone of genius, right? You and your husband, you come from leadership positions, leading your teams in your professional careers, bring that knowledge over. And I think for anyone listening, you always want to bring who you are to the table, right? We're not all going to act like Elaine and try to replicate exactly what you have, but we all have our skills that we have learned and
Absolutely.
developed over the years that can absolutely serve us when it comes to building a successful real estate business. So, what are those skills? How can you leverage that? And then who can you tap into to help surround you and build this team, to build the culture, to help be a great leader? And you talked about, the masterminds and the strategic coach and those things. I think it's really important to hear you say that just because a lot of times
Mhm.
people give, um, I don't want to say credit, but they almost assume like, well, Elaine's, of course, look at all of her degrees. Of course she can do this, right? She's a brilliant doctor and her husband's a tech engineer. Of course they can do this, right? But a lot of it is, yes, you have the ability, but you've also surrounded yourself with the coaches, the mentors, the
Absolutely.
advisors who can help keep you on track. And this is
Absolutely.
not a business that I know very many people who have just created a nine-figure business by themselves without
Mhm.
help, without having strategic advisors around them and mentors and consultants around them helping to advise them. So it just goes to show that if you really want to commit to this and build a successful business, you're going to have to surround yourself with people who have been there, who can advise you, and who can help you be great. And then your role is as a leader, right? You are not necessarily, talking to residents or talking to contractors or negotiating whether or not, this carpet should be $1.78 a square foot or $1.99 a square foot. Like you're not in that part.
Right.
You're focused on creating the systems, the teams, the processes, and then really encouraging your team, empowering your team to lead the best way they see fit to get the results that the company is looking for. So as investors, both on the active side, on the limited partner side, I think it's really important to understand some of those things when you're looking at who you're investing with and who you're going to partner with. You want to have people who are really leaders in their business who are helping to drive that success. Elaine, for folks who want to learn more about you, your website is meetblackswan.com. I'm sure they can learn more about investing with your team and some of the deals and projects that you have going on there. We're going to go on to our round of insights. Are you ready?
Can I do one little thing
Please.
yeah.
Yeah.
So I grabbed Traction. It's a book I keep right on my stand over there. Traction is by Gino Wickman. Gino Wickman is a student of Dan Sullivan. Dan Sullivan is the creator of Strategic Coach. So if you need to rewind and listen to that, but that kind of gives you the genealogy of these ideas. So if you're thinking, I don't have the time in my schedule for Strategic Coach, or I can't afford the cost, or whatever mastermind, this isn't an advertisement for Strategic Coach. First of all, that's probably a limiting belief. We can all find ways to get into the groups and the masterminds and the teaching that we want. But Traction is, what, $18, phenomenal book that can help you lead your own personal life and certainly lead a team. Highly recommend that. And I 100% agree with you on, we have to surround ourselves with coaches, mentors, peers, people that are further ahead of us on the journey, legal help, accounting help, all of those things. I love the kind of very loose ratio of it in any given week or month or year. We should spend about a third of our time with people who are further ahead of us in the journey. So we're learning and growing and stretching. About a third of our time with our peers. So we're there saying, hey, what are you seeing today? Here's a problem I'm having. What are you doing? You're kind of sharing that peer knowledge. And about a third of our time leading people who are behind us on the journey. And when you do that, you get this like really beautiful confluence where you're constantly growing, but you're also constantly, stretching back and helping. And there's a type of growth that comes from teaching as well. And I love that kind of third. I learned that from medicine. It works so well in real estate investing and entrepreneurship as well. So just had to throw those couple of things in. Highly recommend the book Traction for anyone that's thinking about systematizing a business.
Well, I love it. And typically when we do our round of insights, the first question I ask is a different one. But since you just mentioned Traction, I'm going to ask that. Give me the book you've recommended or gifted the most in the last year.
Traction is very good. A different one I'll throw out. I wouldn't say it quite fits that criteria perfectly of gifted the most in the last year, but I recently read it. It's called I Know How She Does It. I Know How She Does It by Laura Vanderkam. Laura is a time management expert who has spent her career collecting 1 week time logs from people for every 30 minutes in their day for 7 days. I Know How She Does It is specifically high income professional women with or without children. That was not part of her criteria, but it looks at real women. How do they spend their time? How are they figuring out how to balance family, their own selves, children, parents, business, work? It was like the whole time I was reading it, my mind was just blown. I'm like, wow, that's so helpful. I should implement that practice in my life. I need to call this friend and share this with her. Laura has several books that are non-women specific. One is called 168 Hours. I haven't read that one, but I'm sure it's good. Another is called Tranquility by Tuesday. I'm about halfway through that. So anything by Laura Vanderkam, she's a time management expert. I have been devouring her stuff in the last, 6 to 8 weeks and have really benefited a lot from it.
I love it. We'll put both of those books in our show notes there. All right, give me a failure or an apparent failure that set you up for later success.
That's a common question that comes up, and I like, it's hard for me to wrap my mind around it. And that's not like a fake answer of I don't want to share my failures, or I want to pretend that it's all sunshine and rainbows, or that I'm above, the fray and bad things don't happen to us. The truth is there are failures every single day. Like the moment I end this call with you, I'll go to my email and there will be failures in there. There will be a negotiation that hasn't gotten to the finish line yet, a problem with our leasing team. I shared, I was talking with our leasing team earlier today about some vacancy. There will be something, a partnership or something that we're trying to move forward that isn't going somewhere. I could choose to live in a world where I see all of that and I just constantly feel like I'm, getting hit by balls, like failure, failure, failure. And I learned from many people, Tony Robbins, Gary Keller, Napoleon Hill, right? Many of the greats that we all know about, that the story we tell ourselves defines everything. And so I just choose to believe that there's no such thing as failure. I just choose to believe that if you wake up and you continue to walk the path and continue to move forward, there are setbacks and there are things that you don't want to happen that happen, but as long as you keep going, it's impossible to fail. Another spin on that is The Obstacle is the Way by Ryan Holiday. That's a concept. That's also a name of a great book, but it's kind of the idea that if you're walking along and you come to this big boulder in the road, you could stop and you could say, I guess I just don't get to walk this path anymore. or you can figure out how to get around the boulder, over the boulder, under the boulder, move the boulder, whatever it is. And then once you have gone past the boulder, you can figure out how to get past boulders in the future. And you have a skill set that someone who hasn't gotten past the boulder might not have yet. So the obstacle is the way. So there's failure all day, every day. It's how we define failure and the story that we tell ourselves. And so, something that I probably say it to myself at least 2 or 3 times a day when I get those emails or those conversations or those things that, we're trying to get something rezoned and we get turned down by city council or just all this stuff. Like, the obstacle is the way. And once I figure this out, it's then a skill that I will have until the end of time.
Give me a digital or mobile resource you recommend for your business.
We love Google Workspace. So our email is based on Gmail. Google Drive, as simple as it is, right? It's not an ultra, high tech, great, like proprietary software, but it's so simple. Everyone can access the same spreadsheets. Everyone can be updating them at the same time. You can have it on your desktop. You can have it on your phone. We have what we call our pipeline. It's a very comprehensive spreadsheet that has, 15 or 20 tabs along the bottom. And it's basically every part of our company. We have our KPIs, our key performance indicators is our first one, our leasing dashboard, our renovations dashboard, our cleaning dashboard, everything, kind of all the main parts of the company going across. And we manage the whole company out of that spreadsheet. Nick and I can look at that spreadsheet, we can spend 10 minutes in it, and we can know the status of the company, and we can have a leasing team member, out in the field showing someone an apartment unit, having that on their phone, updating it, seeing it in real time. Our construction manager can be here in the office at a computer, updating the exact same spreadsheet. There's so many like great softwares out there like Monday and Trello, and we use Buildium and QuickBooks and all of those things. But there's nothing that beats the simplicity of Google Workspace.
I love it. Give me your daily habit that helps you stay focused on your goals.
So for the past about year and a half, I have been in the gym 5 days a week. And that, a year and a half ago, that felt impossible. I fought it for years. If I don't have time for that, I have all of these children, I'm building this big business. We were talking earlier about coaches, and my coach, I have a really wonderful mindset / real estate coach, a really great coach. And I went to him and I said, I am not allowing you to talk to me about anything real estate until you believe at the beginning of each of our calls that I'm meeting my health goals. And that was a tough thing, like a tough boundary to put into place, because in the weeks after that, I would have a deal that I wanted to talk about, but he didn't quite feel like I was meeting my health goals. So like 45 minutes into our 1 hour call, I'm like, I want to talk about this deal that we're working on. He's like, nope, are you in the gym? Are you eating? Like, we're still talking about these things. And that really solidified that habit in me. And I still meet with him once a week. It's something we talk about every single week. And now I crave the gym. I do a lot of heavy weightlifting. The thing that has really changed, kind of my excitement for the gym is I just can't do cardio. I just hate it. It's just so boring. I just watch the time and I'm like, oh my God, this is the worst hour of my life. But lifting weights feels amazing. And you come out with this energy and this excitement. You can see improvement week to week. So that's something. I'm even now, working on a 6th day a week of trying to get into the gym, either Saturdays or Sundays. But it has changed my life. It has changed my life as a human being, as a mother, as a business leader. The amount of energy I have that I can bring to the table, it was very hard. It took years to get this habit into place, and I am so grateful that I have it today.
I appreciate you sharing that, but also sharing the context around it, because I think that's really inspirational for a lot of people who are trying to, be healthy, make better decisions, and it's a challenge for a lot of people. So it's great to hear you talk about how you overcame that. All right, give me your number one insight for real estate investing.
Oh, that's a tough one. The number one insight. The thing that comes to mind is you're never pencils down. You're always in the game. So early on, we did not have the amount of money that we have today in our private equity funds. So there were times when all of our money was deployed into deals that we were renovating and working on refining. And yet we stayed in the game. We kept analyzing deals, we kept doing showings, we kept thinking about, well, what would we offer on this property or what would we do on this property? Through COVID, as many people were treated, we stayed in the game. You never put your pencil down. You're always analyzing, you're always thinking. That doesn't necessarily mean that you're always making offers, but it means that you're thinking about, would I make an offer? What would the offer look like? What would the price and the terms be? Right now, as interest rates are going up, many people have put their pencils down. And when you put your pencil down, you lose that sharpness that comes from being in the market every single day. So then when something does come across your desk, you don't really know if it's a good deal or not. You might be in the world of a quarter or 2 quarters ago and might accidentally think this is a good deal, or you might not have realized that the market has shifted and you might think, this isn't a deal, but it really is. And so you're always pencils up, you're always analyzing, always in the game. It's not timing the market, it's time in the market is another way to say that.
I love it. All right, let's lighten the mood completely because you are out there in Rochester, and I have no idea the restaurants they have there. So, what is your favorite place to grab a bite to eat?
So there are a lot of really lovely family-owned restaurants here. Rochester has a really lovely multi-ethnic, multicultural population because of the Mayo Clinic. A new restaurant that just hit the town is called The Well. It's right across the street from one of our beautiful buildings that's residences of Old City Hall, which was literally the Old City Hall of Rochester that's been converted to a luxury apartment building. So you just walk out the steps of Old City Hall, right across the street is The Well that opened, I don't know, maybe 4 or 6 weeks ago. My husband and I had a chance to have dinner there. Just a good vibe. There's kind of bringing back some of that excitement to downtown that was lost, through COVID. Lots of others, but that's one that comes to mind.
I love it. We'll make sure we put that on the list here and in the show notes. Elaine, I want to thank you for your time today. I mean, just phenomenal insights all throughout, but I loved hearing your story, you and your husband kind of working together to build out this company. You talking about how you focus on really returning capital back to investors, right? You talked about it as infinite returns, finding properties that are distressed where you could come in with your business plan, add value, and within 5 years, return that capital back to investors and look to hold on to these assets so that you can get those infinite returns. Talking about kind of the structure of your company, how you're looking to be vertically integrated, how you have the different companies and the different, maybe services that other people would outsource, like cleaning and some of these other ones. You're bringing them all in house and you're allowing that to help your business continue to flourish. And the focus on leadership, being in a leadership position, focusing on how to run the company, the different skills that it takes, the different mentors, advisors, and coaches that it takes to help you kind of stay focused. I think it's really helpful for us to understand what it takes to get to that next level. Again, if you want to learn more about Elaine and some of the projects that her and her team are working on, you can go to meetblackswan.com and we'll make sure we link to that in the show notes. Elaine, I want to thank you again for coming on Multifamily Insights. We look forward
Yeah.
to staying in touch with you, and I hope you have a
Thanks, John.
great day.
It's been my pleasure.